I think a lot of clients, they've come to us, a new client, right? It's come to us on a call. Hey, I saw the big, beautiful bill. I'm depreciating everything. I've got a net loss of like 300 grand. I'm excited to carry forward, not pay tax for many years. And that's where, hey, you need to make sure you're applying those appropriately, because that's definitely another trigger for the IRS. If they see you've got millions and millions in revenue, but you've got a loss year after year, somehow you keep operating, that's going to be something they key in on.
Welcome to Compass Mining Podcast. I'm Nina Xiang, and we are talking to Nick Ward, a CPA and co-founder at the network firm again, because it's Q4, and you know what that means. It's never too early to start year-end tax planning. So, Nick, great to see you again.
Yeah, it's great to see you too, Nina. Thank you again for having me back.
So, how do you like Q4 as a CPA?
It's good. It's, we're in the actual 10/15 deadline, right? For all my late filers or extenders, they've got a couple more weeks to go ahead and get their prior year returns done. So we're certainly busy these next couple weeks. And then, once we get past that, then Q4 it's a good time of year, right? We can do a lot of strategy with clients, planning for next year. There's still time to take advantage of some of the strategy versus, if you're talking to us next February or March, you might be a little too late on some of those things. So very much enjoy the end of the year from that perspective.
Yeah, awesome. So, so before we go into, the best part of this podcast, which is going to be strategies for year-end tax planning and all the pro tips you can get, let's cover the ground a little bit and setting the stage a little bit on just Bitcoin mining tax primer, 101 lesson on Bitcoin mining tax issues. So maybe very, briefly, Nick, could you just give a little bit basic ground covering for tax issues related to Bitcoin mining?
Yeah, no problem. So resetting the stage, the IRS back in 2014 dubbed Bitcoin property. So what that means is when you are mining and you earn Bitcoin, you're going to recognize revenue at the point you earn it. So, I'm sure most of us are using a mining pool. The mining pool will credit your account for that day for Bitcoin earned. You should track that cost basis or value at that date for revenue recognition upon when you receive it there. That'll be your cost base going forward. So just, let's use today's example. If you're lucky enough to mine one Bitcoin for the day, it hits your mining pool account, you've got $120,000 cost basis in it, and you'd recognize that as ordinary income revenue. And then, like I said, because the IRS has dubbed it property, you'll track that, and when you convert it to US dollars or any other fiat, or you use Bitcoin to maybe purchase more machines, pay a utility bill, pay your employees, you would take the value of the Bitcoin at that time. So let's just say, fast forward to a week and we're at $125,000 and you sell it all for US dollars, you've got a $5,000 capital gain that you'd have to recognize on your taxes.
Thank you. So in terms of, we're going to talk about revenue recognition later, but in terms of the moment when you recognize Bitcoin revenue when you mine it, does it matter if you take the time of the Bitcoin hitting your wallet as a cost base, basically the fair market value of Bitcoin at that moment, or is there accrue basis you could do that? Does this really matter for Bitcoin mining purposes?
What I would tell clients is you, of course, if you want to be extremely precise, could look at that exact moment and take the price. I think most people in a practical sense will just take the price for that day and apply it to the Bitcoin earned for that day. And what I would say there too is, one of the keys with the IRS or even financial reporting is being consistent. So if you're going to use the day's close price or open price, just continually use that going forward so that you're not bouncing around, because that's when the IRS could, start to beat up your approach if they notice, hey, on day one, you use the close price. On day two, you use the open price. On day three, you use the exact price at the time. So what I would say is just be consistent, but it's certainly acceptable to say, I'm just going to take the price for that day, apply it to what I earned that day, and that'll be my cost basis on that lot.
That's really helpful. So, for 2025, what are some changes that miners should be keeping in mind?
Yeah, and certainly we'll plug our last episode here, but
Yeah.
one of the keys was the big beautiful bill, which ironically didn't reference Bitcoin directly, but it referenced depreciation and specifically bonus depreciation. So previously, bonus depreciation was capped at certain levels, and so that's right, the expense you take on your capitalized mining equipment and other capital assets used to power those machines. So it was previously capped and phased down where you could only take so much each year. Now that's back to 100% bonus, and bonus depreciation specifically can take you into a loss position. So let's say you've got a net profit of $100,000, but you've got $300,000 of new machines or depreciation left on machines. You could take all of that in the current year, bringing you to a loss of say 200,000. Now you've got a tax loss that could be used for the future, or at least taking down your tax owed in that current year. So I'd say that's the largest one that we've been focusing on with our mining clients.
All right, go back to the, I guess, tax 101 issue. Another important decision people have to make is to decide whether they're treating mining as an individual kind of hobby or as a business. So how do miners determine whether they are classified as a hobbyist, a sole proprietor, or just running a business?
Yeah, it's a little nuanced with the IRS, right? Because, I think a lot of, I'm sure your retail clients, even myself included, I have one or two machines plugged in. They're on and off throughout the year. So I still treat myself as a hobbyist, especially because I don't run them all year round. I wait till it gets cold here in Ohio, help heat the garage, things like that. But essentially what you can do is you create an LLC, put your mining operations in there. And generally, that's going to help satisfy that requirement. And so when you do that, it opens you up to allow to depreciate your equipment, expense other costs against the income that are related to the mining operations. And so I think that's kind of the key point, is to take a step. If you haven't finalized, created a separate business, you haven't been tracking it, separating your personal accounts from the mining accounts, you should take those steps, because again, that's all going to support your treatment of that business and make it official in the eyes of the IRS.
So I think you just talked a little bit about the bonus depreciation, Section 179. We talked about those extensively in the last episode. Is there anything else to add, from a year-end tax planning perspective?
Yeah, and maybe a quick clarification point on that is there's the bonus depreciation is what I just spoke on, so that's up to 100% now. And then there also is Section 179 depreciation, which is a little different. And so Section 179, similar to bonuses, for new equipment that you've placed in service for that year, you can depreciate 100% of it up to a break even. So Section 179 cannot take you into a loss position. So in my example of you've got $100,000 net profit and $300,000 of new machines, 179 could only take you to, you could only apply $100,000 to that, where bonus could go over. Now, why that's important is Section 179 only applies to equipment placed in service that year. So for any miners you've put in service for 25, you could do 179, but next year you can't do that again. You'd move to bonus. And so there is some strategy around, hey, do we start with 179, get us to break even, and then decide on the bonus? So that's one big piece. And again, I keep saying this, but I'll specify for the audience, the equipment has to be placed in service. So you need to get that equipment plugged in and hashing to actually apply bonus depreciation or 179. From there, then you'll want to look at, ensuring you've got all your deductions in place and you're tracking those accordingly, right? So these are costs to power your machines. So if you're hosting, right, it would be hosting costs, of course, your utilities, the depreciation. If you have specific contractor costs to maintain your equipment, those would also fall in that bucket. And then there's certainly, outside of mining, going to be other tax strategies, right? So if we've exhausted our depreciation, we've got all our deductions in, but we're still at a significant profit and have a large tax bill, that's when we'd strategize on other things like charitable deductions, and, IRA contributions, all these things that I think are deeper down the weeds, but are part of the strategy. So that's why it's important, a lot of people, maybe you're only closing your books a couple times a year, you're waiting to year end. It is important to try and do that analysis now to get at least up 3/4 in to get a picture of what you're looking like, because we have that time now to go ahead and, hey, let's get those charitable deductions put in place, or like I said, the retirement contributions, things like that before the year's over.
Yeah, very important. So I think for miners, a lot of times they would be selling their perhaps older generation miners off and then buy newer generations. So or they could be buying used miners. So that really complicates the picture. So can used miners qualify for accelerated depreciation or expensing? So for people who are buying used miners.
Yeah, I think in most cases, if the equipment's newer to you, the used isn't going to matter much, right? Because when you're buying it while it's used, you're going to place a new piece of equipment in service. Now, what I would say is the useful life of that service likely is lower if it's an older model. So maybe a brand new machine, you could argue, has 3-year useful life, which means we can depreciate it over 3 years. And again, when we're talking about bonus or 179, we're accelerating that to 1 year. But for a used one, you may only have a 1-year useful life. So then that would be a section of miners that I would absolutely separate from the rest of my fleet, because when I'm deciding on 179 or bonus, I'd want to accelerate the ones that have a longer life where, that 1-year new used miner, it'll hit its depreciation within a year anyways. So may not make sense to, use our 179 or bonus on that specific machine.
Yeah. And how about for miners who are upgrading their equipment? So selling off the older ones and buying new ones. And suppose a good strategy is keep buying the latest generation of miners to hit the most efficient machines. How does that obviously you have to think about how do you depreciate that, to keeping in mind there is depreciation recapture. So if you sell those miners in a year or two, you have to plan that. So how would you think about the best strategy there?
Yeah, no, that's a great point. So let's, maybe break that down a little bit. So the depreciation recapture Nina's talking about is once you've fully depreciated that asset, and you could kind of think it's similar to when you're selling Bitcoin, right? Your cost basis in it now it's zero, right? You've depreciated it, so you've got an asset you're selling. So anything you receive for that is likely going into the gain bucket. And that's where, again, that depreciation you accelerated is going to go into that equation and up the amount of the gain you're potentially receiving. So that's, again, when we talk about looking at the tax picture holistically, you'd want to identify that, because if you're upgrading your equipment, right, you're expending capital, but you want to know every piece to that puzzle. So you might have cash coming in from selling the old equipment, but let's net out our taxes, net of the depreciation recapture on that first. So all right, this is now the number I have to spend on new equipment. And then from there, again, it comes down to, for us, a lot of that planning is on where are we at in the year. Because if you're going to, by the time you place your order, receive your equipment, if we're into December, it may make sense to hold off and just plug that in on January 1 so we can apply taxes to next year. But it also may make sense to get it in and plugged in before year end, because, hey, we've got a lot of profit here. We need to get our new equipment up and running, take advantage of that depreciation, and offset some of those taxes due.
So how about people who host their miners with companies like Compass Mining? Are hosting fees, how are they treated, as fully deductible or as operating expenses?
Yep. Yeah. So generally, hosting expenses are going to be fully deductible. Right? You're hosting a machine; those are costs for you to run and earn that revenue, so it can offset that revenue. When you get into, if there's distinguishments of potentially, if this is going to not necessarily apply to retail, but your larger business customers that are maybe grabbing a larger piece of the facility, and maybe they're investing in development and setup of that facility to be, maybe it's more energy efficiency or creating, cooling, liquid cooling centers for their miners within the host site. Those could be subject to capitalization, right? Which again, then they'd still be depreciable, but those are some of the distinctions to make. But generally, if you're just paying a host site to host the equipment, handle, making sure the machines are plugged in, monitor them for you, deal with any repairs, those are all going to be able to be expensed and placed as deductions against your mining income.
And for other costs like shipping, insurance, repairs, are those also like operating expenses?
Yep. Yeah. So shipping generally would be an operating expense to get your, whether you're receiving them directly or shipping to sites. The repairs and maintenance, again, it depends on how large they are. And then I'll also call out for, even retailers who have their own business, they've set up their own business, right? They're mining under that business structure, not as a hobby. We would have clients, you set a cap X policy, it's called, right? Which just says, hey, for our business, if we've got anything that's below $2,000, we go ahead and expense that regardless of what it is. And then everything above it would be subject to capitalization. So that's usually step one is, hey, let's establish that policy. And then again, each repair though, if it's above that, we would look at it and go, hey, did this improve or extend the useful life of the equipment? Then maybe that would get capitalized versus just expensed outright. But that's an analysis that we'd go through. And then I think what was the third bucket was insurance. Generally, insurance would apply as a deductible expense. It depends on how the policy works, of course, and if it's prepaid right all up front, then you'd only expense those portions that apply to the period. But generally, yep, that would go in the expense bucket.
Now, another, I guess, topic that's recently we covered in Compass Mining is we recently energized a gas mining facility, basically using like stranded gas for electricity for that mining site. So how do you treat like off-grid energy setup, using whether either it's solar, hydro, or flared gas?
Yeah, so there's not much difference in terms of the things we've talked about, but I know calling back a few years ago now, the Inflation Reduction Act included some additional tax credits for like renewable energy, solar, everything you're discussing. And so if miners are investing in on-site solar, batteries, or grid support structures like the gas flaring, there's significant credits up for grabs. Devil's in the details for actually obtaining those, but I know, I believe it's up to like 30% on some of those costs that can come back as credits. If you're retrofitting or building your own data centers, that same credit path applies. And there's definitely more on that front in terms of actually building the structures that you can apply to both the real estate investment you're making and all the upgrades. And then lastly, there are still that renewable credit sector where, right, if you've gone over where you've earned these credits, you can't necessarily deduct them yourselves. There's a market for actually reselling those, and of course a whole rabbit hole to go down of is that good or bad, net negative in terms of the ultimate goal of being better for the environment. But they do exist and they're part of the playbook. So if you're earning those energy credits, you want to make sure you're applying, take advantage of what you can, and then you're revisiting this renewable energy sector because maybe you won't be able to apply those to your own books, so you could resell those, get capital in to help growing your fleet and getting more hash rate online.
Yeah, the world of like incentives, credits, and related deductions to those incentives are just such a complicated world to navigate. What's your suggestion in terms of like where to find resources, or just go to a CPA like you who knows the in and outs and can better take full advantage of those incentives?
Yeah, I mean, definitely start with your CPA or your trusted advisor if it's someone else, and I would say as soon as you're going to be going down that path, Because what's likely going to happen is they'll help quantify, okay, how much are we actually investing in this? What does it look like? What's the potential outcome we're going to obtain? And then, we have partners, frankly, that are experts in this field that we would bring into the fold because they're the ones who are really going to help identify. We can point out the tax credits that are there and help make sure we're filing the right forms with your taxes. But when it gets into that secondary renewable credit market, how to track those, that's where you definitely want an expert who's focused on it because they're going to be, frankly, more efficient. They're going to be able to see around the corner and help get to that final point we've been touching on here about, all right, you can apply X credits, but then you'll have, Y in your bank. And, therefore you could have capital to go resell those on that secondary market, should that be part of your strategy.
Very helpful. Thank you. So now let's talk about record keeping and compliance. So we previously, mentioned about revenue recognition, and it's such a huge job just to kind of like keep track of your cost basis, and also for later capital gain tax. So what is the best practice for record keeping? Are there useful tools you recommend?
Yeah, I mean, the good news is the tools, there's numerous tools out there now in terms of software that, right, you can plug your mining pool, plug your wallets right into it. It will start to grab that data automatically. You can tell it what price you want to apply. So as we talked about earlier, maybe it's the open price on Coinbase or CoinGecko, or it's the close price. You can tell it what you want to apply so that it does that consistently, and it'll track those lots, right? So each day it'll flow into your system, it'll apply a fair value price, and now you've got a good record there. If you don't have a software, then it becomes an exercise of making sure that your internal team is tracking those in the same way. And what I would say is, a lot of the mining pools, they have good data. They give you that full record of, hey, here was your hash rate you sent us that day. Here's the rewards you earned. Here's your withdrawals when you took it out of the pool account into your own wallet. But what I always remind clients is make sure you're downloading those regularly, because sometimes you get a year or more down the road and that mining pool maybe only keeps 6 months or so, and you're in this situation where you're pinging their team to try and get that data. So just ensuring that you're capturing whatever pool you're a part of, whatever exchanges you're utilizing to maybe liquidate Bitcoin, you're keeping those monthly statements is what I would say is the cadence. You're downloading those to support your records in your tax returns, right? That ends up there. So that's a key piece. There's also good news there's multiple softwares that help monitor all your machines. So while it's not so much full tax compliance side, just keeping an eye on your operations in terms of uptime of the machines, efficiency is going to be key to ensuring, you're tracking, hey, maybe we do need to replace or upgrade equipment from that perspective. And then on the fixed asset side, so again, when we're talking about depreciation, these fixed or capital assets, so all your mining machines, power supply, cable, these things that are cooling equipment, right, that all support and actually help your machines go plug in and hash, you'll need good detailed schedules of those machines. So, right, what I always recommend is you've got your classes of fixed assets. So miners would be a class, but within that class, then you'd want to track it by each individual item, frankly, or at the very least, items batched and when they got placed in service and the type of model they are. Because like we talked about earlier, that brand new model likely has a 3 to 5 year useful life. But if you do have some older models or you're buying used equipment, that might have a separate useful life. So having that schedule to support the depreciation, to show your advisors, your CPAs, here's my full picture. Here's my strategy in terms of when I want to upgrade. Let's now talk about how much depreciation we're going to take and apply. It'll both support compliance on the tax side of what we report. Here's the schedules to back it, but also then as we move to strategy, here's what we've got. Here's the full picture so we can break it down and start to be very specific and intentional about, where we're taking depreciation, when, what we're reselling, and all those good things.
Mm-hmm. So those are good practices, but what are some of the red flags that the IRS is looking at for, crypto, Bitcoin audits?
Yeah, I mean, it's always hard to say where or why people are getting pooled, but I do know, some things the IRS they do give us some commentary on where they're looking. So I know one big areas on partnership structures. And so we've certainly had clients set up mining operations as a partnership, right? Where you've got different classes of partners. Maybe they're individuals, maybe they're businesses that are investing, and there's investors within those businesses that are the actual partners. And so I know that's definitely one area. So if you've got a partnership structure, they've said that's a key piece, not necessarily Bitcoin related, just in general. So CPA partnerships are in that bucket, frankly. But that's one they're definitely looking at where they think there's a lot of complication, thus potential for unpaid taxes to recapture on their front. When it comes to Bitcoin in general, right, I know they're getting, if you're going to exchanges and you're liquidating a lot, you're racking up this 1099 DA or 1099G form. So they get this gross amount. And so Bitcoin miners certainly are going to have these large numbers going to the IRS. It doesn't give them an insight into what's the cap gain loss like your traditional stock 1099s. But at least triggers them to go, okay, maybe there's something here. And then, I believe their process, they'll compare that to the tax return, what's reported, and then make a determination. But and then on the depreciation front, again, you need to make sure you're applying it correctly. I think a lot of clients, they've come to us, a new client, right? It's come to us on a call. Hey, I saw the big, beautiful bill. I'm depreciating everything. I've got a net loss of like 300 grand. I'm excited to carry forward, not pay tax for many years. And that's where, hey, you need to make sure you're applying those appropriately, because that's definitely another trigger for the IRS. If they see, you've got millions and millions in revenue, but you've got a loss year after year, somehow you keep operating, that's going to be something they key in on. But again, there is a bit of randomness to it. So you never know. You just want to be prepared, because when you do get audited, right, you'll get a statement. And I've been through it with clients that says, hey, we're auditing you. Here's a giant list of stuff we want. Give it to us. And if you don't have those records, it can be really disruptive to your business operations, right? Because now you've got people on your team that need to spend, if you have no records, right, it could be weeks to months of time that they have to take to go ahead and gather all those records, put them together, send them to the IRS, then you're getting on calls to go through it. So if you do all that up front, if you get audited, you can, I'm sure there's still some anxiety that comes with that letter regardless, but you at least know, all right, I've got all my records. I know they support what I filed. So here you go. Let's go through the process.
Oh my goodness. That sounds like that's where you could hear a lot of the horror stories with IRS. Like what was some worst case you've seen?
So frankly, it's on the individual level, but yeah, we had a couple, one specifically of an individual who filed their own taxes. Actually, they weren't our client, and then they got a letter. And this is a few years ago, but they got a letter, and that letter was, we want all your bank statements, every wallet, all the detail, right, for the whole year of, I think it was 2019 or 2020. And the individual he reported a larger gain on the taxes, but they asked for all that. We had to go through it, and you have to, you could take the chance of going through it yourself, but right, he wisely got tax legal counsel, got CPA counsel, and that all comes with costs. So now he's incurring costs to deal with this. You don't know the outcome. Then you get on calls and they're just beating up transactions. Hey, what is this send here? We saw that. Why wasn't that reported? Well, that was a wallet to wallet transfer, so non-taxable, right? But he still had to take that time, I don't know, all in, it was probably 8 to 12 hours of calls with the IRS, and then, us in the background, probably another 8 to 12. So it's a lot, and it's not fun. And, the good news is that didn't result in this significant tax bill, because he generally reported them correctly. It was a small amendment we made and a little bit of tax owed, but it could go the other way where you've got significant amounts you underpaid, and therefore then you're talking about interest on that tax, penalties, which, that's what you don't want to do. Because in most cases, right, you've spent the money, you thought you paid your taxes, now you've got to come up with funds to bill. And, the IRS will work with you. They'll allow payment plans, but it still is not worth it. Anyone that's got gains, I tell them, like, let's be above board, get those taxes paid correctly and on time. So you don't want to pay them more than you need to, frankly.
Well, let's hope no one who's listening to this podcast would ever, have this happen to them. That really sounds horrible. So, all right, let's move on to international hosting or like foreign tax issues. Because for us, for example, we do have mining facilities in Canada. So how should those be handled?
Yeah, it depends certainly on the jurisdictions you're in. Generally for the US, you're going to still identify those, bring them into your fold, right, and report them similar to how you report everything else. There are some foreign tax credits that can offset some of it if you've separated operations that are in different jurisdictions. But like I know Canada, for example, if you're there, they're going to withhold local taxes on your hosting and mining rewards. So again, it's kind of in that audit bucket of, are you seeing the full picture with your advisor, and have you identified, hey, I have a location. Again, we'll stick with Canada. I have a location in Canada. I've of course reported that revenue on my U.S. tax return, but I would then ask, well, did you withhold the local taxes there, right? And if the answer is no, we've got to catch that up. And so again, each jurisdiction is different. Not every foreign jurisdiction may require withholdings, but if they do, you certainly want to make sure you've got those. Trying to think of other things. There's other import taxes, VAT taxes that could come up, duties, import duties right on rigs, even if you're shipping from there or if you're shipping to there. So those are certainly issues you want to be aware of. And then there's also double taxation that could pop up. If you've set up a foreign subsidiary, but again, it's a subsidiary of a U.S. entity, you could face that local tax there and then again, tax in the U.S. So that's where, if you're going to go down that path, sit with your advisor, right? Let's say, hey, we've identified what we think is a cost-effective location internationally. We've laid all that out, but maybe that tax piece, the local taxes there, the U.S. Requirements for things earned there aren't part of that budget. You should definitely get those on the sheet so you can make a very informed decision.
Awesome. Thank you. So thank you for laying out all those very insightful tax issue advice. But now is the most important question for today. What are your best strategy for year-end planning for 2025?
Yeah, I mean, again, it's a little redundant, but hey, make sure if you haven't closed your books, right? Maybe, I know a lot of businesses, there's 100 different things you need to do. And sometimes the accounting is a secondary thought where you've got a cash runway you're monitoring, what that is, or maybe you generally know that you're in a net income or break even net loss position, but it's high level, right? You haven't really pulled in all your expenses. You haven't taken the time to really close the books to date. Take the time to do that, and to the best you can. If it's up to June, fine, that's better than nothing. Again, I'd argue trying to get to September 30th, at least 3/4 of solid data is going to really allow you to make the best decision, but that's step one. So again, get all your records together, get as best a full picture as you can, and then sit down with your advisors to look at, all right, what is our position at currently? You can do a quick projection, right, on where we think the Q4 would go based on those numbers. And then we can start to break down each bucket of, all right, let's start with depreciation. Have we taken advantage of everything we can there? Have we taken other deductions, like I mentioned earlier, the charitable, the retirements? Have we done that? Then you get into things, if you've got a Bitcoin treasury that you've been accumulating, maybe there's some loss harvesting we could do there, right? So those are, the strategy really starts with, hey, get the best picture of your books closed, and then get time with your CPA, your advisors, to start to break that down and strategize what we can do to minimize our taxable income.
So let's focus on tax loss harvesting then. What are some good tips you can give?
Yeah, so again, Bitcoin, digital assets in general, the rules, there's a rule called the wash sale rule, right? So with stocks, equity, what that means is if I sell an equity at a loss today, I can take that capital loss against any capital gains for the tax year. But the wash sale rule prevents me from rebuying that stock within, I think it's 30 days. Otherwise, if I sell it today and I buy it in 10 days, then I can't take that deduction. And right, it makes sense because it's preventing you from saying, I'm selling an asset that I don't really want to sell because it's at a loss currently, so I can offset some capital gains, but then I buy it right back. Because the IRS has dubbed Bitcoin and crypto property, the wash sale rules don't apply to property. So to date, you still can take advantage of that, meaning you could liquidate Bitcoin at a loss, buy it back, and still essentially, right, have the Bitcoin on your books, but take advantage of a loss for the year. It's something
Whoa.
I've been surprised, that they haven't
Yeah.
addressed it. I think some politicians have raised it as an issue. Generally think it's fair that you would raise it because, again, it doesn't apply to other liquid assets generally, but to date, the rule's still out there, so you can take advantage of that. And that is, and then even for other assets you have that maybe wash sale rules do apply to, you still want to go through that exercise because, again, if you've got capital gains on Bitcoin, which again, we've had another good year price wise, so likely most people are in that position of anything they've sold or they've used Bitcoin to purchase assets, they probably have gains. Maybe you have other capital assets that are at a loss that you don't necessarily need to hold long term, or they're not part of your long term picture strategy. Then definitely encourage you to look at those, and that would be part of the equation of, okay, we could liquidate some of those to offset gains and use that new capital to either, again, increase the fleet, buy more Bitcoin, anything that makes sense for the business.
Mm-hmm. So let's say you have been running your mining operation with a mining hosting service provider, and let's say due to some extended repairs or maintenance, you have been offline, and therefore, let's say your mining operation has been accumulating all these operating losses. And how does that get carried over forward?
Yeah,
Whether
so there,
it's this year or sorry, go ahead.
yeah, no, it's a good question. So what we're talking about here specifically is, hey, your net position. So after you've accounted for all of your revenue, your expenses, you've got a net loss, right? And we'll just stick with $100,000 net loss for simplicity's sake. You can carry that loss forward indefinitely, meaning, every year you think of it as an accrued account that is at $100,000. And the next year you've got $20,000 of income, you potentially could offset some of that with that loss. Now, there are limits. So generally, you can only apply, I think it's 80% of taxable income in the future year. So you can't wipe out 100%. Even though you have 100,000 and you've made 20, you likely are stuck at 80% of that 20 that from the 100 you could apply, right? So you can take it down very significantly, but you'd still have 20% left of it sitting in income. So you can't wipe 100% of it going forward. And that's on the net operating losses specifically.
And are you offsetting, can you offset wages or other business income, or both?
It's basically the net of the following year. So to your point, you would apply all your wages for the current year, all your other deductions against your revenue. You'd get to your net number, which let's say you're in the green, 20,000. That's what that net operating loss can go against. But again, it can't offset 100% of it. I think it's 80% in that year. Then there's the capital gain or capital loss carry forward bucket. So now this is, we've earned our Bitcoin, paid taxes on it, we've sold it at a loss. Let's say we've sold $10,000, at a loss. You can always offset the capital gains in the current year fully. You can carry forward those losses indefinitely, but when you're carrying capital losses forward, you can only offset your ordinary income. So again, that previous net bucket up to like $3,000 for individuals. Businesses, I'd have to double check the rules on the amounts, but again, it's very limited in how much of that can actually go against normal income, but you can carry it forward indefinitely. So that's a good point on that. The net operating loss is really where your business miners are going to be focused on. Okay, we've got something accruing. Obviously Bitcoin is still volatile. We'll continue to see if we're still in this cycle phase or not. Because I don't think, this current bull market certainly isn't over as of today. Yeah. And so, but when those drawdowns happen, mining is a very, very competitive, tough business. And so that's where it's not going to be a surprise that you're in a loss position. But the good news is, hey, those losses can be carried forward. So then when we're back in the bull market cycle, you've got something to help offset some of those significant gains.
Awesome. Now, last question, looking forward to 2026. Are there anything you're watching in terms of, potential policy or IRS guideline changes anything you're expecting that could have impact?
Yeah, as of right now, from what we see, there's nothing significant. I think, of course, the shutdown is interesting because I've seen, potential opportunities for other bills to be passed, in between or after as they make deals. So we're certainly watching that closely because I think to come, that's usually when we have seen some significant policy changes, right? Because they have to come to the table. Both sides are, hey, well, we think we want to get, another tax credit in for businesses or not to meet your side's thing, get to a deal. So we'll watch that. Otherwise, not a ton on the radar. One thing, though, that was very interesting that actually, I think this was last week, right at the end of September. If some of your viewers had seen that digital asset treasury, there was this concern. Basically, the Inflation Reduction Act created this corporate alternative minimum tax, which is like a 15% on larger firms' book income. So what that means is like unrealized potentially fell in there. And there was a concern that unrealized gains on Bitcoin would be counted in the total book income and then put these corporations in that bucket to have an additional 15% tax. And the IRS and Treasury came out last week and clarified that, hey, unrealized gains on Bitcoin and digital assets would not count towards that. So that was definitely a huge, very good thing to get clarification on because, first of all, unrealized gain tax is a scary thought in general for even businesses, right? I think there's a lot of opinions on how much tax business should pay, but when we're talking unrealized gains causing a tax payment, right? These are assets that, yes, Bitcoin's very liquid, of course, but still, now the business is in a position where I have to liquidate this asset that I plan to hold long term to cover this tax due, even though I haven't realized it yet. So I was very happy to see that. I think that's definitely a positive on that front for, and it applies to miners because while they're not the digital asset treasury companies, it's a similar model, right? Where, hey, their goal is to accumulate Bitcoin, keep as much of it as they can. They certainly have a lot more pressure on selling because they have to fund their operations. But generally, we've seen many of them take that position of trying to accumulate. And the thought of having to then get bumped into this 15% corporate tax due each year would only deplete that treasury and, certainly complicate the strategy part of their world.
For sure. Yeah, definitely. Well, thank you so much, Nick. Always fun to talk to you on taxes, as much fun as you can have talking about tax issues. But still, thank you so much for spending the time with us today. And we will be sharing your contact information and links in the show notes. And thanks for tuning in to the Compass Mining podcast. Remember to follow us on social for the latest insights and education on Bitcoin mining. Keep hashing and see you in the next block. Thank you.
Thanks, Nina. Thanks, everybody.